So welcome back to Financial Accounting. What I'm going to do in this little mini lecture here is I'm going to lecture on the last three objectives of the Chapter 5 that we're responsible for. So we're going to describe and illustrate the adjusting process for a retail business. And then we're going to describe and illustrate the financial statements and closing entries for a retail business. And then we're going to take a look at the insights provided by the asset turnover ratio. So we'll go lecture on this, and then we'll do a couple of quick exercises first. So let's start with the first one, the adjusting process for a retailer. So two additional adjusting entries that we have to make, one for inventory shrinkage and one for customer returns and allowances. So even though we're using a perpetual inventory system, not everything that affects inventory is actually recorded is either as a purchase of inventory or a sale of inventory. So if you have theft of the inventory, if you get damage to the inventory, even though you have a perpetual inventory, you've got to periodically, you've got to count the inventory and actually compare what you actually have to what you're supposed to have for the books and records. And this gives rise for something called inventory shrinkage. And then also, since we try to match costs and revenues, if you have sales during the period, you know from experience what portion of those sales are going to be returned. So you also have to account for the year estimate of the return of merchandise that's going to come. Right? So these are two adjusting entries. So first one we're going to look at is inventory shrinkage. So we know we got a perpetual inventory system, but the amount of inventory that we actually have is going to be different than the books and records. And this could be, look at the third bullet here, as a result of shoplifting, employee theft, or just errors that we have made. So we count the inventory, and the difference between the inventory per our records and the actual inventory is called inventory shrinkage or inventory shortage. So here's what we got. So in the general ledger, the balance of inventory, we look at the T account inventory, we've got the beginning inventory, we've got all the purchases of inventory, we got all the sales of inventory. That's going to tell us what's in inventory. But then we've got a physical count of the inventory, and we notice that the inventory is $1,800 less than the books and records say it is. So we make an adjusting entry, debiting cost of goods sold and crediting inventory, and that brings the inventory down to the actual balance of $62,150. And essentially, the $800 shortage is recognized as additional cost of goods sold. If this number becomes really large, then what they might do is they might set up a special account called loss from inventory shrinkage, or they might actually just disclose this in footnotes. You've heard in the news recently, unfortunately, in some of the crime-ridden neighborhoods right now, a number of significant retailers have closed shop because the inventory shrinkage, the theft of their inventory has just become too much for them to handle. Right? So we have an adjusting entry for inventory shrinkage. We also have an adjusting entry for when we record sales. Again, we're trying to match revenues and expenses. So we know from past experience that some of the sales that we have are going to be returned to us. So we're going to have to make adjusting entries. We're going to have to assume that some of the stuff is going to be returned, and we look at our past experience for that. So we're going to have an adjusting entry for sales returns and customer refunds. And then also what we're going to do, if we're going to adjust the sales for the amount that's going to be returned, then we have to also anticipate how much inventory is going to come back to us. And we're going to have to make an estimate of that amount as well. So we're at two entries here. So let's look at the fact pattern here. So let's assume we got an unadjusted trial balance at the end of December for this year. These were the credit sales. These were the sales. These were the cost of goods sold. And you've got a balance in estimated returns inventory, a $300 debit balance, and you got a credit balance in customer refunds payable. Now, at the end of the period, you estimate that another $5,000 of the stuff that it cost, the stuff that's going to be returned, we estimate that 5,000 of that is going to come back. So that's going to be your adjustment to inventory. And we estimate that 1% of the sales are actually going to have to be returned. So we know that we're going to have to provide for $5,000 of the inventory being returned. And we know that we've got to provide for 1% of $715,409 being returned to us as well in terms of reducing the sales. So my two entries are as follows. The first one is to record the customer refunds payable. So I take 1% of sales, and so I actually reduce sales by $7,154. And then I I increased the liability account, customer refunds payable. So when customers actually return stuff to us, then we don't debit sales again, we debit customer refunds payable. But that's the adjustment we make at the end of the period. And we also make an estimate of the cost of the inventory to us that's going to be returned. Obviously, we're going to have a difference between what we paid for and what we sell it for. Remember, we sell it in large quantity at a lower price, and then we sell it in smaller quantities to our customers, and there's a markup there. So when we adjust our estimate of what's going to come back to us in the cost of the inventory, we debit estimated inventories, returns inventory, and we actually credit cost of goods sold, because the stuff that's going to be returned to us is going to reduce the cost of goods sold. So if we make those two adjusting entries, then we look at the adjusted trial balance, and we've got a bunch of new accounts here. In fact, the thing is so damn big, I can't fit it on one slide here. So notice there's an account 115 we didn't have before until we got to this chapter. Account 16, estimated inventory returns. We didn't have that one before. And then look down at the bottom there. We've got customer refunds payable, estimated coupons payable. Those are two new ones that we had, 213 and 214. And then we've got the rest of the trial balance looks pretty much the same, although we've got a new expense account here, 510, called cost of goods sold. But again, all trial balances, all we're going to show is the debits equal the credits. This is an adjusted trial balance for a retailer. So there are more accounts involved here because of the fact that we've got to account for the inventory on the balance sheet and the sale of the inventory on the income statement. So there's my adjusted trial balance. Okay, so once we do the adjusted trial balance, I move my head there, we know that we can now go ahead and do the financial statements and do the closing entries. So the closing entries are going to be exactly the same. There's going to be more accounts involved here. So the closing entry is going to be the same. The income statement is going to look a little bit different. We're going to have what we call a multiple step income statement. So there is my multiple step income statement. We call it multiple step because there are multiple steps. So it's sales minus cost of goods sold. That's very important. That's our gross profit. So we're actually selling the inventory for $187,950 more than we paid for it. So we get the gross profit, then we have the operating expenses, and we segment the operating expenses between selling and administrative. That gives us the total operating expenses. We reduce gross profit by operating expenses. That gives us the operating income. That's the amount of income made from our primary business. If we have other sources of revenue and expense, such as we have some small rental income, I guess we have some unused space that we rent. And then also we have interest expense. Now, why do you say we put interest expense down here? Because the interest expense is as a result of how we choose to finance our business. It's the interest that we pay to the banks or creditors is not directly related to the purchase and sale of merchandise. So there's our multiple step income statement. We know the cost of goods sold. We know the excess of sales over cost of goods sold. We know it's gross profit. It was the first practice exercise we did. And then we have operating income, sometimes called income from operations. This is, you subtract the operating expenses from the gross profit. And the operating expenses are normally segmented between, let me move my head here, between selling expenses. So these are expenses directly related to the sale of merchandise, and administrative expenses, sometimes called general expenses. And these are general expenses that aren't directly related to sales. So in the operating income section, very important, this concept of multiple steps. So we've got the gross profit, which we calculated as sales minus cost of goods sold. Then we have the operating expenses. So when you do this, there should be a subtotal. You list all the selling expenses and you get a total. All the administrative expenses, you get a total. So that's your operating income, the difference between the gross profit and the operating expenses. That's not net income though, because you've got other sources of revenue and other sources of expenses. And other sources of revenue are not directly related to your primary business. And other expenses, these are expenses that you have that are not directly traced to the business itself. Right? So you get operating income plus the other revenue minus the other expenses. So this can be either positive or negative, depending upon whether the expenses are larger than the income. So in this particular case, the interest expense actually exceeded the rent income by 1840. So your net income is the operating income minus the net difference between the other revenue and the other expenses. Another alternative is what we call a single step income statement. You'll see this sometimes even for, unfortunately, even for retailers at times. So this is just a very simplified version. Notice here, we don't have the sales minus cost of goods sold. If I ask you to do an income statement, I would likely ask you to do not a single step, but a multiple step. The statement of owner's equity is the same for a retailer as it was for a merchandiser. So beginning capital plus additional investment plus additional net income minus withdrawals. Obviously, if you had a net loss for the year, that would be a subtraction rather than an addition. Balance sheet is now, we learned from an earlier chapter, I forget which chapter it was, I think it was either 2 or 3. We have now a classified balance sheet, which means we segment the assets between the current assets and the property, plant, and equipment, get a total. And now we've got so many accounts, it's going to go on to 2 pages. So these are just the assets we're looking at. So there is the balance sheet broken down between the current assets and the property, plant, and equipment. Notice with the property, plant, and equipment, I've got to take and subtract out the accumulated depreciation on the store equipment and the accumulated depreciation on the office equipment. And the 21,400 we call the book value, and the 18,850 is the book value. Book value is defined as original cost minus depreciation we've taken in previous periods. So there's the assets. There's the liabilities and the owner's equity, and you see why we have to do the financial statements in a particular sequence. We got to get the income statement done first, so we can do the statement of owner's equity. Then we got to do the statement of owner's equity, so we can correct owner's equity balance sheet. Okay, closing process. Now, some of you struggled with the closing process on the last exam. There was a problem on that. And not all of you got the full 13 points. That would probably be an understatement there. So remember, there are 2 entries. You close out the revenue and the revenue accounts by debiting. You close out the expense accounts by crediting them. And any difference between the revenue and expense, which you anticipate, if you've got net income, that would be a credit to capital. If you have a net loss, it would be a debit to capital. So we close out the revenue and expense accounts in the first entry. And the second entry is we close out the drawing account. So the drawing account is a capital account with a debit balance, but it's a temporary capital account. That represents the amount the owner has taken out for personal use. So that has a debit balance. So on that one, you're going to debit the capital account, credit the withdrawals. So here are the closing entries. And the only difference here between what you had seen in earlier chapters is you've got more accounts involved here. So again, the first 2 closing entries close out the revenue accounts. So we had sales and we had a little bit of rent revenue. And then we got to close out all the expense accounts. So new expense account here, we have cost of goods sold. And notice here, and we knew this when we did the income statement, the revenues exceeded the expenses by $80,400. So that is a credit. The reason we credit capital here is that represents the net income. Or another way of saying that, it represents the excess of the revenues over the expenses. So please spend some time if you're struggling with these closing entries to really hone in on this, because it's a key concept in the course. So whether the story about the salmon helps you or not, I don't know. But remember, the closing entries closes out all the temporary accounts, and the temporary accounts are the revenue accounts like sales and rent revenue, all the expense accounts like cost of goods sold and insurance expense. That's the first entry. And then the second is you close out the one temporary stockholders owner's equity account, which is the drawing account. Okay, so there's the closing process. And then once we get the closing process done, then we can do a post-closing trial balance. And again, you know from previous experience here that the post-closing trial balance is all the permanent accounts. Said another way, those all the accounts that appear on the balance sheet. All right, just last thing I want to mention here is each chapter now will be introducing a financial ratio. So I said basically in this course, we learn how to record transactions, we would prepare financial statements, and we'll get a little bit into each chapter analyzing the financial statements. And one of the ways we analyze the financial statements is we look at how effectively the business is using its assets to generate sales. And the higher that ratio, that indicates a effective, if you're comparing 2 years, in 1 year you've got an asset turnover ratio of 4, and the other year you got an asset ratio of 3. Well, in the year that you got the 4, you're doing a much better job using your assets to generate sales. So it's a pretty simple formula. You get sales off the income statement, and then you get the assets at the beginning of the year and the assets at the end of the year, add them up and divide by 2, and that gives us the asset turnover ratio. So here's the little fact pattern that we're given. So you look on the surface here, say, oh, well, it looks to me like year 2 is more profitable because we must have had more sales. Look, the sales went from 23 up to 25. These are in millions, so $2 million difference roughly. And then however, we got to relate the amount of sales to the amount of assets they had. Notice that the assets here at the beginning of the year in year 1 were 13,000. Here they were 19,000. Assets at the beginning of the end of the year here were 19. Here they're 20. So there's a difference between the amount of assets that we had each year. So remember the formula, it's sales divided by average assets. So actually, when you compare these 2 years, what you'll see is we actually did a better job using the assets to generate sales in year 1 than we did in year 2. Why do I say that? Because the asset turnover ratio in year 1 was 1.43, and in year 2 it was 1.27. Now, don't fall into the trap that a lot of people do. In fact, I'm teaching an MBA class at St. Joe's this semester, and they just had a homework problem where they had to do all sorts of ratios. And I did a wonderful job on all the ratios, but they missed the most important part. What does the ratio tell you? Okay? It really doesn't tell you anything until you compare it to something. So here, when we compare it to we can compare year 2 to year 1, and we can say, well, they're not doing as good a job. Why do I say that? Because the asset turnover ratio has declined. It went from 1.43 to 1.27. So ratio in itself doesn't tell you much until you compare it to something. So you can compare it to previous years, as we did here. Also, you can compare it to your competitors. So if you're a Staples and you're looking at your asset turnover ratio, you probably want to compare yourself to Lowe's. If you're Ford, you probably want to compare yourself to General Motors. If you're a Stop and Shop, you probably want to compare yourself to Wallbounce. Right? So that's the asset turnover ratio. And that's about as far as I want to go, because we're not going to get into the appendices. So I hope you found that little review useful. And again, for those of you who missed class, I'm really doing this video for you on Thursday. In the future, if I'm going to miss class, which is very rare, I'll send you an email and I'll let you know. All right. I'm going to do another little mini lecture, and that little mini lecture is we're going to go through practice exercise 6 and practice exercise 7. So go attempt those, and then come on back for the last video on chapter 5. Be well, everybody.